You can lose money on real estate and still get paid. That sounds illegal. It's not. There is one real estate tax rule that turns paper losses into actual cash. And it's the same rule that quietly helps wealthy investors pay little to no tax while everyone else wonders how they do it. Today I'm breaking down exactly how it works, who qualifies, and how to use it correctly. Because if you misunderstand this rule, you don't just miss out. You can lose six figures over time. This isn't theory. This is how real estate investors legally turn losses into leverage. Let's get into it. Here's the weird part about real estate. Your property can be cash flow positive, go up in value, and still show a loss on paper. And that loss is where the magic starts. The rule is called depreciation. But most people misunderstand what it actually does, so they never unlock the cash part. Depreciation lets you deduct the wear and tear of a property even if nothing is breaking. The IRS assumes buildings fall apart over time, so they let you deduct the value slowly. Residential property is depreciated over 27.5 years. That means if you buy a rental for $275,000, the IRS lets you deduct roughly $10,000 per year, even if the property is perfectly fine. That deduction shows up as a loss on your tax return. And here's the key. That loss can offset income, but not everyone gets to use it the same way. Now here's where people get confused. They hear real estate losses can offset income. Then they buy a rental and realize the loss does nothing for their taxes. Why? Because depreciation follows permission rules, not ownership rules. And the IRS has three different buckets of people. Most people don't know which bucket they're in. Bucket number one, passive investors. If you have a W-2 job and you don't materially participate in your rentals, your losses are considered passive. Passive losses can only offset passive income. Not your job, not your business, not your spouse's income, so the loss just sits there, carried forward, unused. This is where people think depreciation doesn't work. It works. You're just locked out. Bucket number two, active participants under the income limit. If you actively manage your rentals and your income is below certain thresholds, you can use up to $25,000 of losses to offset non-passive income. But here's the problem. That benefit phases out quickly. Once you cross roughly the mid-six-figure income range, it's basically gone. Which means, ironically, the more successful you become, the less useful this version of depreciation becomes. Bucket number three. This is where the rule turns losses into cash. This is where wealthy investors live. And this is the part nobody explains clearly. If you qualify as a real estate professional, for tax purposes, depreciation losses are no longer passive. They become active losses. Active losses can offset W-2 income, business income, capital gains, almost everything. This is the rule. This is the switch. And this is how someone can make $300,000 and legally pay tax as if they made $80,000. Now, before you click away thinking this is a loophole you can't access, listen carefully. Real estate professional status is not about being licensed. It's not about selling houses. It's not about calling yourself an investor. It's about time. You must spend more than 750 hours per year in real estate activities, and more time in real estate than in any other job. That's roughly 15 hours a week, and those hours must be real. Acquisitions, management, repairs, bookkeeping, strategy, tenant communication, not browsing Zillow. This is why the IRS audits this category heavily, but when done correctly, it's powerful. Let's make this real. Imagine you own 3 rental properties. Together, they produce $40,000 in cash flow, $90,000 in depreciation. On paper, your tax return shows a $50,000 loss. If you're a passive investor, that loss gets parked. If you qualify as a real estate professional, that $50,000 offsets your income. If you're in a 30% tax bracket, that's $15,000 in tax savings. That is real cash, not deferred, not theoretical. Cash you keep. And here's where it gets even more aggressive. There's a technique called cost segregation. Instead of depreciating everything evenly over 27.5 years, you break the property into components: appliances, flooring, electrical, plumbing. Some of those get depreciated over 5, 7, or 15 years, which means you can front-load depreciation. That turns a normal loss into a huge loss. This is how investors create six-figure deductions in year one, legally. Now, let me say this clearly because people mess this up. This is not about faking losses. This is not about gaming the system. This is not something you wing. The IRS allows this on purpose. Why? Because real estate creates housing, creates jobs, stabilizes communities. They reward activity. But if you cross the line, audits get ugly. So here's the rule you need to follow. If you want losses to become cash, you must do three things. First, know which bucket you're in. Second, track your time, obsessively, calendars, logs, notes. Third, work with a tax strategist, not just a form filler, CPA. This rule only works when structure meets documentation. Now, if you're thinking, I don't have 750 hours, here's the interesting part. In many households, one spouse qualifies, which means the losses can offset joint income. This is why you'll see families where one partner focuses heavily on real estate while the other earns high W-2 income. That's not accidental. That's planning. Let's bring this home. Real estate isn't powerful because it always makes money. It's powerful because it gives you control over when and how you pay tax. Depreciation is the lever. Real estate professional status is the switch. And structure is the difference between hearing about this and actually benefiting from it. Here's your action step. This week, pull last year's tax return. Look at your passive losses. Ask one question, why am I not using these? Because chances are the money is already there. It's just trapped. If you want, comment depreciation below, and I'll make a follow-up video breaking down cost segregation in plain English, audit red flags to avoid, and whether this strategy makes sense at your income level. Because losing money on paper and keeping money in real life is how real estate actually works.